So in case you hadn't noticed, there was a crash in early February. Unfortunately for me, being a Philadelphia Eagles fan, it was literally the day after they won their first Super Bowl ever. And market apparently didn't like that. I guess the market wanted the Patriots to win. And so we had a drawdown, a significant drawdown on our options desk as a result of the crash that happened in early February. This wasn't just some ordinary crash either. This was the VIX going from historically low levels to a very high level in one day. And people have called this a Volapocalypse, a volatility apocalypse, that event. It was quite an increase in options volatility. As most market neutral options traders know, most of our trades are negative vega, meaning we respond poorly to volatility increases, and so you can imagine how bad that can get when volatility explodes. So we took a couple of weeks to sort of analyze what happened which caused that drawdown, and broke it down into its components, which is very much within SMB's culture of improvement. What happened? What can we do to improve in circumstances like that in the future? And so today's video is to share with you 4 major observations that came out of that. And the purpose of this is to ask you to look at yourself and say, are these modifications to my trading style that I should be taking into consideration, given the fact that a volatility apocalypse can happen easily again at some point in the future. It almost definitely will happen at some point in the future, and you've got to be prepared. So what were the major observations we had? And first of all, we looked at our maximum losses, and we asked ourselves, on our trades, are our maximum losses necessary? The reason you have a maximum loss is so that things don't get out of hand, but they have to be loose enough so that you don't get stopped out of trades which would have been winners had you not had such a tight maximum loss. We found out through some self-analysis that in fact our stops were a little too loose, that in fact in most cases a trade which is down a certain percent is very unlikely to come back from that percent. And so therefore, if your maximum loss is 15%, and you've noticed through observation that once a trade gets down 10%, the chances of it getting to down 15% are pretty high, then you might as well have your stop be a smaller number. That way you don't have to experience that difference between the original stop and the new stop. And so you should ask yourself, how many times do you really come back from being down 80% of your stop? If the answer is never, you might as well move your stop up and save yourself some money. On the other hand, you have to be very intellectually honest about this. If your stop is exactly where it should be, then you got to leave it there and come up with other solutions. We found that our stops were a little loose. We tightened those up. That's going to help us in the future. The second major observation we had is that when you put multiple trades on in multiple time periods, you have to ask yourself the question, suppose every one of these trades got stopped at the same time. Typically, that doesn't happen. The trades which are farther out in time are much less prone to being stopped out than the ones that are closer in time and subject to higher gamma, okay? But when you have a very serious event, every trade you have on is exposed to being stopped out. So you have to be aware of that. We decided to create some limitations around how much capital can be exposed at any one time to any one event, regardless of how unlikely it is that a particular trade can be stopped out, because with a big enough volatility increase and a big enough move in the market, every trade you have on is subject to that particular event. And so therefore, you should ask yourself the question, am I exposing myself too greatly to an extreme event? It may be an extremely unlikely event, but it's still a possible event. Am I exposing myself too strongly to that? If the answer is yes, then you've got to look at how much capital you've got exposed at any one time. Ask yourself the question, what if this all went at once? What if I got stopped on every trade at once? Is that a number I can live with? If the answer is yes, you're good. If the answer is no, you've got to find a way to reduce your exposure to the very large events. So that would be our second observation. The third observation is when volatility reverses and goes from historically low levels to historically high levels, it can get nasty. And it got nasty. And so you need to deal with that issue in some way. Most of our trades are negative vega. That's market neutral options trading. So you need to have a way of dealing with these explosive events. There were a number of hedges that were out there on that day that actually performed quite well and as expected and as advertised. Our trading desk has adopted one of those hedges and is using that currently. You should ask yourself the question, do I have a way to deal with an explosion in volatility within my portfolio of trades? If the answer is no, I highly recommend you look into some of the hedges that are out there that are very, very helpful in these environments. And finally, the final observation is it's a good idea for us to diversify things so that not all of us are exposed to the same basic dynamics at once. So we have begun to shift around the capital in our portfolio of trades within our desk so that there is less diversification, I should say more diversification, less heavy correlation, and therefore in the future an event like this should be much more bearable because we will have different trades responding differently to the same event. So you should ask yourself, is your portfolio of strategies diverse enough? Is it diverse enough? And if the answer is yes, that's super. You probably had a reasonable experience on February 5th and 6th and so forth. But if you had too much in the negative vega bucket and not enough in other strategies that might respond, for example, positively to volatility increases, then perhaps you should be looking for some more diversification. So that is, those are four of the major observations that we had coming out of our loss on February 5th and February 6th. And I'm suggesting to you that you conduct a similar self-analysis. Look at the four issues we've raised today. Maximum losses, multiple trades in multiple time periods, volatility exposure, and diversification. Look at those issues and ask yourself, have I addressed these? Because I assure you, you need to address them. Whether you reach the same conclusions we reached in each category, that's going to be dependent on how you went into such an event, how you are currently structured. But you should have a checklist of issues that need to be looked at in order to resolve the exposure that you have to a very, very large shift in volatility and a very large drop in the market. So do that. Learn from the lessons we learned. Take that information, apply it to yourself, ask yourself these questions, and most importantly, act on it. That way you will be able to live to trade another day and long-term be a successful trader. Thanks very much and see you next week.